All right. Well, Shane, good to see you.
Hello, my friend. How are you, Kyle?
Doing well. So, today is what? I think it's April 7th and you're out on the road. So
Yeah, I don't
tell
know
me
what
about,
day it is or where I am or anything like that. Yeah, I'm a little out of sorts, but it'll be fun to chat for a few minutes, kind of get caught up on the day's activities. I woke up this morning on Hilton Head Island. Got to see the sunrise. Had a nice ocean view from the bed I was sleeping in, so that was cool. And I was just happy to see the sun because the I guess last night it was just raining and tornado watches and lots of lightning and thunder. So I was just happy to actually see the sunrise this morning. That was cool. But now I'm just outside of Charlotte. I guess I'm still in South Carolina though, so not I didn't quite make it all the way to Charlotte, but
yeah,
getting ready to head to the first day of the national conference on Christian apologetics. So looking forward to that. I've never attended anything like that before, and one of my, I don't know if you want to say heroes, but one of my heroes of the faith, Frank Turek, will be there, and I'll get to meet him and shake his hand. So looking forward to it, and just having a couple of days out of the office with my wife is going to be cool. So
awesome. Well, that sounds like a great time. And, I know you're staying in a hotel room, so I'm just curious. Inflation, the last print was around 7%. Do you feel like that's what it is based on your hotel room cost?
at least I actually paid. I went one exit too far, and the price of gas went up like 50 cents a gallon. I was paying like over $4, but the prior exit was like under $4. So I think it cost $90 to fill up the Jeep with regular unleaded gas. That's the highest number I've ever seen, and yeah, no fun at all. Coffees are expensive. Hotel rooms are expensive. They don't do daily house cleaning anymore, which is fine. I usually don't get I usually didn't, or house cleaning, not house cleaning, but housekeeping. I usually didn't get that done anyway. I would just put the sign on the door and say, leave us alone. Because my wife tends to tidy up the rooms as it is. So, but yeah, they can't even do that anymore. I mean, I have a feeling it's more than just inflation. I think it's, COVID and people not wanting to go to work. But both hotels I've stayed at, um, have not offered daily housekeeping. In fact, let's before we jump into the spy, what is this? This Marriott looks like it wants to roll over anyway. So maybe it's time for Marriott hotels to drop back to the 200-day moving average. That's another 6% lower. Maybe it wants to go even lower than that. Could drop another 15% easy to get back to the lows we saw here in November. So I don't know. Marriott, I think is like a really good stock to hold in the long run. But I'm not sure. Not sure how it's gonna work out in the short run. It's kind of like it's one of these stocks I look at as like a trophy asset, but you got to pay the right price. And I wonder. I actually, sorry, I know this isn't what we planned on talking about today, but
It's all good. And, fundamentally at Marriott, I've always been very impressed with them.
yeah.
And right now, it's like you're saying, if you can just pick it up at the bottom of that channel, it's a nice spot, kind of in the middle of it right now.
But look at this. It's trading. Sorry to interrupt you. 49 times earnings it trades at right now. Look back here in 2015, 21 times earnings, 2016, 30 times earnings, 37 in 2017 after the all-out run. The last time the Fed was doing quantitative tightening in 2018, it dropped back to 20 times earnings. Um, in 2020, it didn't even have a PE because they didn't make any money because COVID shut the hotel industry down. And today, 49 times earnings because the earnings are still so depressed from from prior to COVID. So I mean that's not a price that you want to pay, even though earnings should grow again, right? I mean, I'm not saying that they're always going to earn this amount of money, but I don't know. That's expensive. Price to sales sitting at almost 4 times sales, when in 2015 you could have bought Marriott for 1.26 times sales. So that's I mean that's steep. And my favorite measure is enterprise value to EBITDA. That's how we compare companies that are in different industries. I don't like to pay more than 12 times enterprise value to EBITDA. For a trophy asset, I might be willing to pay like 15 times, but even on that metric, it's still it's double a fair price, you know, in my opinion. So this stock should go down, and its earnings should grow, and those things should meet in the middle. I don't think that means the stock needs to get cut in half. Earnings keep going up and the stock falls a little bit or even stays where it is, you know, eventually it'll kind of catch up to itself. So
Absolutely. Well, do we want to take a look back and just kind of overall market? I know there's a number of companies out there that have high PE ratios, but you know, big picture.
Sorry, I was still looking at Marriott on the screen here, but look at that total revenue, 20 billion, 20 billion, 20 billion, 10.6 billion in 2020. Their revenue literally dropped by 49% in 2020, and it only grew 39% since then. So, I mean, hey, Kyle, here's a CFA question. If you lose 50% of your money, what growth rate do you need to get back to even?
100%.
100%, right? It's not, hey, I went down by 50. If I make 50, you know, I get back to even. If you have $100 and you lose half of those $100, you have $50. From there, you need to double your $50 to get back to $100. It's, you know, very simple. People don't think mathematically or arithmetically, you know, most of the time, but that is how it works. So Marriott's got a long way to go. So do a lot of these other hotel, you know, gaming, leisure, cruise companies. They got a long way to go to get back to where they were before COVID. Anyway, sorry. What do you want to talk about?
Just S&P 500. Let's go back and kind of let's zoom out a bit and just see what the overall market's doing. And
Jump
you
into
haven't
the
even looked
SPY.
today, so you're out. So you know, here we go. First time looking at it.
Yeah, I was out and I didn't stop out of any of my personal positions today. I did check that when I got to the hotel. I stopped out of nothing. So seems like all of my personal positions went the right way. And I'm still holding on. Now that said, I also didn't, none of my limits hit either. So none of them went up enough for me to, or down enough in the case of my shorts. So I made no trades today. That might be the first time all year I made 0 trades. Maybe second, but yeah, it looks like at first glance here, just using the same SPY chart that we've been using on this podcast with all of our little bubbles. We'll get to deleting those here sooner or later, maybe after I write my commentary Monday. But you know, it looks like SPY kind of jumped back up. I bet it was a late day rally because I did look at the markets this morning and they were down. And looks like we just barely finished above the 200-day moving average. So 200-day moving average sitting at 448.03. You can see in the top left corner up here. And looks like we closed at 448.77. So finally respecting the 200-day moving average. But I think the trend is lower. So I think we should go down a bit more, maybe down into these areas, maybe even making a new low before who knows what, I guess. But yeah, it's nice to be back above the 200-day moving average. But I don't think I put a lot of faith in that just yet.
Yeah, and I think the same here. You know, the last 2 days we've just really seen a consolidation. The market's trying to figure out which way to go, but I think if you zoom out and look at like a weekly chart, it doesn't look great. You just have hit weekly quick. I don't know if this shows it. So look at this red candle, most recent one. So that's this week, and the candle has not closed. Yep.
Yeah.
So we don't know yet, but look at the candle from last week, just a giant stuff candle. So the bulls, they ran it up and they pushed it right back down. And here we are this week selling off a little bit.
Yep.
You know, if I had to bet right now, and still kind of a coin flip, not a great trade, but I'm certainly not feeling too bullish right now, but that's where you manage that risk and, you know where the exit is. But I'm not a market predictor, but this is not a spot I want to be. I mean, this was one I looked at last week, was that stuff candle. What a great spot to short the market. You could use the top of that candle as your risk level, short it there. But yeah, I don't feel so great about it right now, especially, you know, inflation. And I think bigger picture, I'll let you kind of drive on this chart, but just on the sector level, the momentum that we talked about last week, just it's kind of gone.
That's what you're saying. So when you say stuffed candle, this is what you're talking about, this one? I never
E-
heard that term before. I'm
Exact.
being, yeah,
And
okay.
it's kind of one used loosely in the group, and stuffed candle or a doji candle or gravestone doji. So essentially
Yeah,
what it is the bulls ran that price up all the way up there, but
yeah,
could not hold it there through the end of the week. So the bears went in there and pushed it right back down, or stuffed it. So stuffed it right in their face, and
got it.
you kind of get that close.
Yeah, and so that's 3% higher from where we closed today, based on the little arrow that I drew there. So the top of this candle is 3% higher than where we closed today. So you could basically, you could go in and short the market right now and use the top of this candle as your stop. So buy to close or buy to cover your short. You'd be risking 3% to make, 8% going down maybe to the lows that we reached back here. So not terrible risk reward, a little over 2 to 1. And if you're actively trading the markets, that's not a bad way to look at it, because it's not on here right now, and a lot of traders don't really put a ton of stock into it. But if I go back to the daily, so there's two things. I drew this yellow line. Maybe this low that we hit back on March 23rd, maybe that actually holds. It looks like there's that little bit of respect being showed for it over the past 2 days so far. We touched that level, and then it seems to have rallied. We touched it 2 days in a row. So I mean, that's kind of bullish. But what is not bullish is if I add the moving average convergence divergence, or MACD, you will see that it is turning red here. So these lines of cross turning red leads to more downside, lots of downside back here. It's not foolproof, right? It's not the basis for a trading strategy, but sometimes when I'm trying to evaluate whether something's likely to keep going lower or keep going higher, breaking out, I use the MACD to kind of break a tie, right? If the MACD is showing me that the momentum is just now flipping negative, I'm more inclined to short that than try and go long right there. If the MACD was just turning green, I'd say, hey, this thing's about to rip. So you never know. We never know. But that's what makes it a market. There's always two sides to that coin. So in fact, I was looking at something earlier today that said these guys that the SEC went after, and maybe Kyle, you can post a link to this or something in the YouTube channel when you finally post this. But these guys, they had advance notice of all earnings releases, and they had, like, I don't know, 150 different companies, and they were still only right. So they still only made money 77% of the time. So even with cheating, getting inside information, knowing what the earnings reports were going to be ahead of time, these guys still lost money almost a quarter of the time on their trades. So even if you knew what was going to happen, it's hard to make money trading, which is why people should stick to investing for the most part, and stay away from actively trading, because it's a very, very, very difficult way to make money. It is not
Absolutely.
easy.
And Shane, I was just going to point out one other thing on this chart to kind of maybe wrap it up. But was it 4 days ago? So that hammer candle, if you look at the bottom of that hammer candle and use that as a level of resistance, today's rally could not close above that level. So that's
Yeah,
kind
that's
of
right. Yep.
that's the line in the sand I'm watching right there, is that if we get a daily close over the bottom of that hammer candle, then I'm starting to feel a little more optimistic short term. But if we can't get over that, I think that this is just a little bit of a rally right before all the hopes of the bulls kind of gets broken and we go back down and try to find new footing.
Yeah. I can tell you for sure, there's nothing bullish about the economic environment. I don't care who you are. The Fed tightening the screws into a slowing inflation and slowing GDP is not bullish in the long run on any fundamental basis. The market does tend to rally during hiking cycles, but the Fed usually tends to hike into a strong economy, not into a weakening economy. So we're in a very strange place. I'm not willing to say this time is different, because that's a real good way to lose money. But I'm very cautious. This rally that we've seen has been, great off the bottom. normal times would say, more to come. The trend is your friend. And so I don't know though. I think times are anything but normal, and I think the Fed tightening and looking to aggressively tighten and reduce the balance sheet. I mean, so you have on one hand the fact that market normally rises even while the Fed is hiking interest rates. Totally true. You can go back and test it. Even in the 80s when Volcker was raising rates, the S&P 500 went up during that time frame. But every single time, and I say this sort of in jest, but every single time the Fed has ever reduced the size of its balance sheet, which has only ever happened one other time in history, in 2018, the market was down during that time and had a very hard time going up. It was the last calendar year that the market was down, was 2018, and that's when the Fed was reducing the size of its balance sheet. It was only able to do it for like 6 months before it finally had to, reverse course and begin easing cycle again. So I don't know. Who knows if they'll follow through on what they're saying. 50 basis point rate hikes, hiking at every meeting, trying to get to a 2% Fed funds rate, which is still not restrictive monetary policy, even at 2%. But an economy that can't handle interest rates at 2%, 3%, how is that a healthy economy? It's not.
Mhm.
No way.
Agreed. And you and I, we're not economists. We kind of get the big picture, but something I just wanted to point out here. I'll flip over to sharing my screen.
Let me stop. There you go. Should be good.
So I pointed this out last week, but just at the sector level. So here's over 1 year, and here's energy again, just
Oh my gosh,
racing
wow.
off. So if you could pick a sector, energy just looks phenomenal. So what I wanted to look at is, I mentioned before, the 20-day moving average, that tells you if there's short-term momentum or not. And you go through the sectors here, and this tells you what percentage of stocks are trading over their 20-day. And now it's, you've got consumer staples, energy, healthcare, real estate, and then utilities. Not really the sectors you expect to lead, but then look at this, just 30%, 40%, 25. So all these sectors have lost their short-term momentum. And on the 200-day, it's even worse. So that's kind of that big line in the sand. And aside from these sectors here, which, so we have 5 sectors in the green, all these other sectors below their 200-day, this just doesn't make me feel very rosy and bullish and want to dive in. This is kind of telling me that short-term momentum right now is not great. I mean, you can own healthcare, you can own energy, those areas, great. Certainly could need to work based on looking at this, but overall, it's just you're not seeing broad participation and short-term momentum kind of getting back to a bullish footing. You're just seeing what looks like a market that doesn't really know where it wants to go, but it doesn't seem to want to run higher right now.
Wow. Yeah, there's some major disparities there. It's like a bifurcated market for sure. And I mean, healthcare is something that tends to do well during what we call quad 4, thanks to the guys at Hedgeye. Just a great macro framework to think about. But during this type of environment, healthcare is one of the places where you definitely do want to hang out. I mean, that's a place to hide. Energy is not normally a good quad 4 play, but we're in anything but a normal market right now. And by the way, I'm not at home. I've got 2 screens, so if you see me like looking over here, I'm just looking at Kyle's screen. So I'm not paying attention. I was actually paying very close attention, and that's it's actually fascinating. So
then, Shane, do you want to take over and go back? Let's look at the yield curve and some mortgage rates. I know that's been a hot topic as, what are rates doing? Because right now it just seems like they just want to race off, and with yield curves, not steepening, it's certainly going flattening or inverting.
yeah, you may want to, I think you need to stop sharing your screen before anybody will actually see mine, but
There we go.
But yeah, here we go. Let's see. All right, so this is what you see on the screen now, right? You can see my screen, can't you, Kyle?
Yeah.
Cool. So this is the 30-year US mortgage rates, and this is back to the beginning of time. So over here on the left is 1971. And you can see what happened with mortgage rates from 1971 till the end of Volcker's hike cycle. Mortgage rates went from 7.4% in 1971 to a high of 18.5% or so in 1981. And again, the market was up, I think, on balance over that term too. Again, you can isolate the Fed hike cycles, and market usually goes up at the same time. But ever since then, mortgage rates have been pretty much in a steady decline with a few, upside ticks. And if I just zoom in here, this high, right? This trend line, this red trend line. Why is the trend line there? I don't think I put it there. Let me see. How did it do that? So if you put this trend line here, there we go. That's where it should be. I don't know if that's because I'm on a different PC or what the deal is, but if you take that trend line back from, October of 1987 and put it at, the high that we saw in October of 2018. So again, this is a lot of time that we're looking at on this chart. You've been looking at the SPY over the past few months. This is a few decades. And this downtrend has been in place for a very long time based on that red line. And then if you look again, just at, at this channel, this dark channel that I've highlighted. And I don't know, this is a little bit off kilter too, but it hasn't quite broken out of the channel yet. If that channel even exists, I'm just going to delete it because it's a little bit off of where I think I drew it last time. But you can see it definitely broke above this trend line from, back in 1987, and it hasn't quite broke above the highs that we saw in 2018, December or November. But that was, again, I think that's partly why the Fed stopped unloading its balance sheet, is because all the rates were going so high, and that was causing the market to drop. We finished the year down in the S&P 500 in 2018, and now these rates are just shooting higher. I mean, in October, I don't know, when was it? I guess as late as November, you could get a mortgage for 3%. I did. I got my new place in Florida. I got under 3%, 2.99, I think is where I was, but under 3% still, even if only by a basis point. And now we're at 4.7, almost 5%. And, I did the math. I think, my mortgage payment at current interest rates would be 23% higher than it actually is, at 2.99. Looked at another way, my house would have to drop in value 19% in order to be able to afford my house, and here's the thing, my house did not go down no 19% since I bought it. It is up by a lot, which is crazy to me. I thought for sure, just because I was buying a house, home values would start to fall immediately, but that didn't happen, thankfully. So yeah, I think this mortgage rate situation is probably the scariest chart out there right now. If that continues to break higher and goes above 5%, there's no telling how high 30-year mortgage rates could go. So I don't know, Kyle, what do you think about this?
I think, it's just looking at it, so you don't have to even be a chart technician. Look how steep that rise is.
Yeah.
I mean, it's alarming. And coming off 5% inflationary environment, I thought I read some headline about the Fed saying that they would hike rates to get the stock market to crash just to get rid of inflation if they had to. They were willing to do that. And, I'll have to go see if I can find that article, maybe post a link to it, but it just a headline I saw, but it's just a downtrending resistance line like that getting broken, and with everything going on, you just have to wonder, how high can rates go? Because that is pretty scary. I mean, you went from 3% to 5%. That's almost doubling in that span of time.
It's crazy. It's crazy. I mean, from the absolute low down here to where we are now is a 77% rise in rates in 400. Oh, not even in how many days? Yeah, 427 days. That's crazy. Absolutely crazy. And if it breaks through 5, we can easily get to 6.8, or anywhere in this neighborhood, 6.6, 6.8. And I mean, that will break the economy. Like, check out here. You want to see something funny? I haven't looked at this yet, but I bet you, if I type in, well, let me just jump to another chart here. But if I go look at a home builder stock, let's just look at the ETF. ITB is the home construction ETF. I bet it's not up. Nope. Nope. It's just down from the highs, right? I mean, this thing's getting absolutely smoked. And, you know, we were long home builders in our growth strategy for a while. But geez, this ETF's down 32% from its highs in January, basically. DR Horton is one of the big home builders. This is one we were long. It's getting absolutely hammered, putting in a fresh low, down 36% from its highs. Lennar, another big home builder. I mean, these charts all look the same, right? They're just getting absolutely demolished because as that rate goes higher, just like I was describing, people can't afford to pay as much for a home. Like that's just all there is to it. The homes have to come down in price, and these guys make money by building houses and selling them for a premium. And you know, the lumber is even going down, I think, from its highs. I haven't looked at lumber. I don't even know what the symbol is for lumber in trading view.
Yeah, I'm not sure what that one is either.
Lumber futures, random length lumber futures. Let's see. Yeah, lumber's down a bit from its highs, and these guys still can't make money. I mean, that was a crazy rip last year. Came down a lot, went up a lot. Now it's back down again. So, yeah, the home builders are going to struggle in a rising interest rate environment, especially with the 30-year Treasury doing, or sorry, not 30-year Treasury, but 30-year mortgage doing what it looks like it's doing here. And you know, the funny thing is you would think that because interest rates at the long end of the curve are going higher, that you wouldn't have an inverted yield curve, but that you would be
Yeah, and how
wrong.
does that look? Because it's all rate of change, right? So if the rate of change on the long end outpaces the short end, well, then you
Yeah.
still have a, you know, steepening yield curve. But in this case, the short end's outpacing the long end.
Yeah, so people think short-term rates are going to go up faster than long-term rates, and that's why, you know, if I zoom in here, the 10 minus 2 was briefly, again, it was inverted, you know, minus 5 basis points for a while. It looks like it's since kind of jumped out of that area. If I go to the daily, it spent, you know, a couple of days below zero. So we were 2 days below an inverted land, and now it's kind of recovered a bit. But again, I mean, once you see that sign, it's usually, you know, within 18 months that you will see a recession. So still be on the lookout for that. Doesn't mean you need to sell all your stocks tomorrow. It's within 18 months, right? So doesn't, you know, you don't want to be sitting in cash for 18 months if the market continues higher before starting the recession. But I think the writing's on the wall. I think the economy's in a scary place. Fed's tightening into it, and to me, it all spells disaster. It's not a time to be getting aggressively long.
And now, Shane, what about, you know, all this kind of doomsday scenario? It feels that way, but we have Bitcoin, right? Is that our safe haven, or?
Yeah, Bitcoin fixes that. Isn't that the saying? Yeah, let's see. I don't know if we've looked at Bitcoin much, but here we go. We got crypto here. So Bitcoin respecting the 200-day moving average. So it's definitely, you know, it's climbed a bit recently, but I think it's interesting that, you know, look at that. Those are perfect tags of the 200-day moving average, and then a drawback. So, you know, wouldn't surprise me to see it come back, test this 50-day. Wouldn't surprise me to see it come back, test this trend line or even this trend line. So I think, you know, I think there's still some short-term downside in Bitcoin. In the long run, I think it's going higher. I'm looking for opportunities to get in. I did buy, you know, some crypto on the breakout, but as of today, I'm all out of my crypto positions until we kind of break through this 200-day moving average level. And the same looks pretty similar on Ethereum. I mean, Ethereum, you know, went up to its 200-day, broke a little bit above it, but then has since come back down. So I think we need to spend some time consolidating around here. In fact, you know, what would be nice is to get, you know, the 50-day moving average and the 200-day moving average to kind of, you know, converge, right? and then rip higher as the red line crosses back above the blue line. Like you can see what happens. See what happens when the red line goes up? When the red line's above the blue line, you want to be long. That's a good place to be. When it's not, it doesn't happen very often that it's not. Like this has been a pretty deep sell-off. So again, the odds are not in your favor if you are long crypto in the short run here. So we'll see what happens, but yeah, I'm a bull. I like crypto in the long run, but today I'm all out of my positions. Do you have any crypto positions right now, or do you even trade crypto? I don't know if
No,
we've ever talked about that.
I've dabbled in Ethereum some, but it's like you're saying, I want to see it capture the short-term moving averages and trend higher. And hey, I might miss a move or two, but I want to know that that momentum is with me. And usually that just works out a lot better.
Yeah.
So, it's close. Like you're saying, we had that nice little run up here. I think it needs to backfill, consolidate, build a base, and then go higher. And especially like you're saying, if you get those moving averages to pinch a little bit, that's an ideal situation there where you can get ready for a good move and the risk reward's a little nicer.
Yep. Yep, that's what I'm waiting for. So I got some alerts set for crypto crossing back above its 200-day moving average. When I see that happen, I'll probably be ready to get heavily long and see if we really break out and go back and test and test the highs. Because if so, there's a nice run to be had, even from the 200-day moving average to Ethereum's high. I mean, that's a 40% run just to get back to here. And for Bitcoin, it's probably similar, but from the 200-day moving average to the all-time high, 43%. So I think yeah, I mean, there's no reason to be buying down here, when the trend is down and it's under the two. Nothing really good happens under the 200-day moving average. No reason to get greedy or aggressive. Take a nibble, fine, but I won't be buying with any amount of size until we get back above this level.
Right. And then, I know we've been going for a bit, so maybe we'll wrap it up, but I just know we've talked about gold in the past. We just want to touch on that chart real quick. And
Gold, haven't looked at gold. I know I keep getting stopped out every time I try to buy it higher. So, this was the last little wedge. It broke out, failed hard. And I guess we could now, do the same thing again and say, here we go. We've got, I don't know if that's a bit of an outlier there. So yeah, on the daily, it looks like it's just kind of stuck in a range, and until it really moves higher, I don't know. No reason to get crazy aggressive on that either. I'd love to see gold break higher. Any breakouts on this, they'll probably catch my attention, and I'll try and take it for a bull run. I probably won't short it, just because I think with real interest rates being negative, right? If you take the real like the 10-year yield minus the inflation rate, you're going to get a negative number because inflation is so high and yields are so low, interest rates are so low that the Fed needs to hike by a lot and inflation needs to go down by a lot in order for us to get to a place where interest rates are actually positive on a real inflation adjusted basis. And if that were the case, I probably wouldn't be a gold bull, but right now I'm definitely seeing more upside. Who knows when?
yeah, and I'm with you. It's set an alert at this point and leave it alone. It's just moving sideways, and given everything, I would have liked to have seen it take off a little more, but it's just not doing anything exciting for me right now.
Yep. And I guess the last one maybe is crude oil.
Yeah.
And crude is still very expensive. Oh, that's the weekly. So going back to the daily, right? It's still stuck in this range. And actually broke this white trend line, which is interesting. So maybe we'll see crude, drop a bit. 200-day moving average sitting at 81.04 right now. So there's a bit further to fall if it's going to go all the way back to the 200-day moving average. I'm not saying it will, but trend is kind of down. It's below the 50. The great thing though is that as long as you're not actually trading crude oil, which I don't ever trade crude oil, because I don't like to trade thing where cartels are involved and can control the price in certain ways if they want to. So I don't ever trade crude oil specifically, but these oil producers, which are represented by the XLE, you know, this can continue higher, still holding above the 50-day moving average, still holding the uptrend line. I mean, with oil at $80 a barrel, going all the way back to that 200-day moving average, these guys are still making lots and lots of money.
Well, I think too, I don't know if you can pull it up, but just nat gas, we can close with that.
And that gas is crazy. The Widowmaker, as they call it.
So,
Boom.
I mean, that is a gorgeous looking chart. You had that nice bottom and now it's just raising higher, but these energy companies, they do nat gas too. That's a byproduct of getting that crude oil, and that is a nice price for them. That's a price they haven't seen in quite some time.
Yeah, but look, that's also ripe for a double top right there. I don't
Yeah.
know. I mean, it's probably, you could see it coming down from there, at least building some consolidation in this, you know, 550 area before going higher. But if it blows through that, who knows? I mean, we're into springtime now, right? So we're out of winter, and that's the prime time when people are actually using natural gas to heat their homes and things like that. So maybe some of the demand will go away in the short run. Obviously, with Russia and their whole conflict situation and people trying not to buy Russian gas, there might be a lot more demand for the gas that is out there that isn't coming from Russia. So I guess, you know, we'll see what happens. But that's why we don't do predictions, man. We do reactions, and we try to jump in the trend when you know, when there's the meat of it. We want to be contrarian at extremes, but with the herd during most of the run. So that's what we'll be looking for. But yeah,
Absolutely.
I should probably wrap this up so that me and my wife can go to dinner. We're both pretty hungry after a long day on the road. So anything else you want to chat about before we call it quits?
Sounds good. I think we got it. So, enjoy your time. And just again, for everyone, this is entertainment purposes. So this is not financial advice, just enjoying our charts and talking about it. So hope you enjoyed it.
All right. Thanks, Kyle. See you later, man.
Have a good one.